Are you curious about how to start investing but feel like you don't have enough money? The good news is you don't need thousands of dollars to begin building wealth. Starting small, even with just $100, is a smart way to grow your money over time. In this video, we'll explain how you can begin investing with as little as $100 and why starting now can make a huge difference in your financial future. So, if you're new to investing, this guide is for you. Stick around to learn some key strategies and avoid one huge mistake most beginners make. Why investing matters. Before we dive into how to invest, let's take a moment to understand why investing is so important. Simply put, investing allows your money to grow. It's like planting a tree that keeps growing bigger and stronger each year. You don't need to keep adding water or fertilizer constantly. Just let time and compound interest do the work for you. For instance, when you invest your $100, you're giving it a chance to grow through returns. These returns can come from stocks, bonds, or other investment vehicles, and they build up over time. Let's say you get a 10% return on that $100. By next year, you'd have $110 without lifting a finger. That's the magic of investing. Your money works for you even while you sleep. When should you start investing? Timing is everything, right? When it comes to investing, the sooner the better. But before you jump in, make sure you've got the basics covered. If you have high-interest debt, like credit card balances, it's a good idea to tackle those first. After all, no investment is going to grow as fast as interest can pile up on debt. Once you're debt-free, the next step is to build an emergency fund. Experts recommend having 3 to 6 months of living expenses saved up. This fund will act as a safety net, allowing you to handle unexpected expenses like medical bills or car repairs without derailing your financial goals. Once you've got your debt handled and your emergency fund in place, it's time to start investing. Investing for retirement. Start small, think big. When you're ready to invest, start by focusing on retirement. Why? Because one day, you'll want the option to stop working and still have enough money to live comfortably. By investing in your retirement now, you're taking care of your future self. A general rule is to invest 15% of your income into retirement savings. If you're just starting out and $100 is all you can spare, that's okay. The key is to start the habit of investing. As your income grows, so will the amount you invest. One of the best places to start is with a 401k if your employer offers it. Many companies will even match a portion of your contributions, which is like free money. If your employer doesn't offer a 401k or you want to explore other options, consider a Roth IRA. A Roth IRA allows your money to grow tax-free, which is a huge benefit over time. How to invest your first $100. Now, let's get into the specifics. How do you actually invest $100? Here are 3 simple and smart ways to do it. Number 1. Robo-advisors. These are automated platforms that manage your investments for you. Companies like Betterment or Wealthfront allow you to start investing with as little as $100. They'll automatically build a diversified portfolio for you, making it a stress-free option for beginners. Number 2. Exchange-traded funds, ETFs. ETFs are collections of stocks or bonds that you can invest in as a whole. With just $100, you can buy shares in ETFs through platforms like Robinhood, Fidelity, or Vanguard. ETFs offer diversification, which means your money is spread across many different investments, reducing risk. Number 3. Fractional shares. Some platforms like Robinhood and Stash allow you to buy fractional shares. This means you can invest in expensive stocks like Apple or Amazon, even if you only have $100. Fractional shares let you own a piece of a big company without needing thousands of dollars. The power of compound interest. Let's talk about one of the most powerful forces in investing, compound interest. Albert Einstein once called compound interest the 8th wonder of the world. So, how does it work? Let's say you invest your $100 and earn a 10% return. By the end of the year, you'll have $110. Now, if you leave that money invested and earn another 10% the next year, you'll make $11 instead of just $10 because you're now earning interest on $110. Over time, your returns will start earning returns, and this is how your money grows exponentially. Imagine you start investing at age 25, putting in just $100 a month. By the time you're 65, assuming an average annual return of 8%, you could have over $300,000. That's the power of compound interest. Small amounts invested regularly can grow into a significant amount over time. Avoid the common pitfalls. While investing can be rewarding, there are a few traps you'll want to avoid. Number 1, timing the market. Timing. The market is the strategy of trying to buy and sell investments based on predicting market highs and lows. However, this approach is highly risky and can lead to significant losses. Even expert investors struggle to perfectly time the market. Instead of trying to predict when to buy or sell, focusing on long-term investing and staying consistent typically leads to better results. Remember, it's not about timing the market, but time in the market that builds wealth. Number 2, high fees. High fees can erode your investment gains over time, so it's crucial to be mindful of them. Many investment products, especially mutual funds and actively managed portfolios, can come with high management fees. These fees may seem small, but they add up and can significantly cut into your profits. Always look for investment options with low fees, like index funds or ETFs, to ensure more of your money stays invested and continues to grow. Number 3, crypto craze. The crypto craze has attracted many new investors, but it's important to approach with caution. Cryptocurrency markets are highly volatile and can swing wildly in value overnight. While stories of people getting rich off crypto are enticing, it's crucial to understand that these assets lack the long-term track record of stocks and bonds. If you choose to invest in crypto, do so with disposable income and keep the bulk of your investments in safer, more established assets like stocks or ETFs. The importance of consistency. Consistency is key when it comes to investing. Whether you're starting with $100 or $1,000, the most important thing is to make it a habit. Set up automatic contributions if you can, so that money is regularly invested without you having to think about it. Over time, those small contributions will add up and grow. It's also important to periodically review your investments. As your financial situation changes, you may want to adjust your portfolio. If you get a raise or a bonus, consider putting some of that extra money into your investments. The more you contribute, the faster your wealth will grow. My number 1 don't in investing. Before we wrap up, let me share my number 1 investing don't. Don't get sucked into get-rich-quick schemes. Investing is a long-term game. While it's tempting to chase after the latest trend or hot tip, these strategies often lead to disappointment. Instead, stick to your plan, be patient, and let compound interest do its magic. Investing doesn't have to be complicated, and you don't need a lot of money to start. With just $100, you can begin building a brighter financial future. Remember, the key is to start early, invest consistently, and avoid the pitfalls of market timing and high fees. If you found this video helpful, make sure to like and subscribe for more tips on personal finance and investing. And remember, it's never too early or too late to start investing. Thanks for watching, and we will see you in our next video.